Shout out to Julian Banks. Yes, sir. And I am Big Snoop Dogg.
For those of you who don't know David Hauser, he's an entrepreneur, investor, and M&A expert. He's known for bootstrapping Grasshopper from 0 to 30 million in ARR before selling it to Citrix for 176 million. He has a wealth of experience in building and exiting companies. Welcome to the show.
Thanks for having me, Julian.
So I jump into Grasshopper. The story is legendary to me. I mean, it's bootstrapping to 30 million ARR, sold it to Citrix. Can you take us back to the beginning, and what were some of those defining moments that shaped the growth? What lessons from that journey kind of still guide your decisions today?
Yeah, it was an amazing journey, and one that we set out on never with an exit plan. So that was really interesting. Like, we sold the company 12 years after starting it, but we never had an exit plan from day one. Our goal was to build a great company that we love being at. And I think because of that, we ended up creating a very valuable company, right? Without intending to necessarily. So maybe there were some things we could have optimized here or there or whatever to make the sale easier, but not having that exit plan meant we were just building a great business that we loved being at, right? So like that meant the right people, the right core values, and the business being profitable again and again and again rather than burning capital. And that really set us up for success.
What were some of those core values? Because I think you had that acronym GARY, right? Which I think I remember. I was going to say, go above and beyond, always entrepreneurial, radically passionate, and your team.
Yeah. So exactly the core values. We drilled those into people. We built it into our hiring, our firing, our rewards, our recognition, every system at Grasshopper, from performance reviews to literally asking people before they even had a like if you were applying for a technical job, before you had a technical interview, you would be asked about core values. We actually asked people to tell us at least 2 stories about themselves living those values, right? So like that was an upfront screening method. Now, it took us a lot of years to actually integrate all that and figure it out. We ran the company without it for the first few years and made a ton of mistakes, hired the wrong people. But ultimately, those values and our core purpose of empowering entrepreneurs to succeed is what made us very profitable and have tremendous amount of revenue per employee. Like we were well beyond $1 million per employee when we exited.
I think the first decision was your co-founder, right? You two coming together at Babson. How did that kind of come together, and what did you guys align on?
Yeah, so interestingly, neither of us were friends with each other. We kind of had mutual friends. We both went to Babson. My partner was a year ahead of me, but I think not being friends going into it was really beneficial because we had to build a relationship together on shared values about the business. Now, I'm sure that half of this or more was just pure luck, right? Like so many people have bad partner decisions, and we didn't do any of the things we were supposed to do. We didn't have these conversations. We didn't, vet anything. We didn't follow a process. We were like, hey, you're thinking about something similar to what I'm thinking about. Why don't we just do it together?
Yeah.
And just went into it, right? And that probably wasn't the best method, but what we aligned on was how we were building and what we were building, right? So we knew that we wanted to build this to be a great company, not from an exit perspective, but just a great company. And we both had the passion of serving entrepreneurs. And that's why when we actually vocalized our core purpose of empowering entrepreneurs to succeed, that's what codified that all and brought everyone together.
Gotcha. And so that was the initial missive. And it was because it seems like you guys just jumped straight into it without having like a web interface. You didn't have like all these technical, things that you needed. You just were like, hey, let's get customers. Let's see what we can do. Because it's solving a need that you guys had.
We had our own need and we just wanted to solve that. So we had nothing. Like we had no web interface. Now, keep in mind, this was quite a while ago when we started. So maybe that was acceptable. But we built the bare minimum, like the absolute bare minimum to sell something and collect money from people so we could market, right? We didn't build a customer service interface. I was taking customer service calls by typing SQL statements in on the console, right? Like that's how I would look a customer up. So really the bare minimum. And this was before like minimum viable product ideas kind of started to be talked about in the startup community. It was really minimum from like, we wanted to provide a phone number that did these things. That's what we built. That's it.
And so for you, because you've done both bootstrapping versus raising capital, how do you decide the right path? I guess at that time it was kind of like we have no choice, we have to bootstrap. But how do young entrepreneurs kind of evaluate that decision when they first start out?
Yeah, I think it's a really important decision. If you asked me this 15 or 20 years ago, I'd probably have a different answer because today there's so many tools that are now free or relatively free from AWS to now OpenAI. All of these tools that we didn't have any of this. There was no Twilio or any of these tools from a voice perspective. So we actually had to build the data center. We had to do these things. Today, there's even less reason to raise capital than there was 20 years ago for the vast majority of startups. I think that there's a few that are very unique, and that's either you need tremendous speed to market because there's a first mover advantage for some reason in the space. There's huge capital costs from a hardware or technology perspective that can't be rented from others if you're building, physical devices or something like that. And now even then, there's probably some ways around that. Two-sided marketplaces where you have to build both supply and demand at the same time. I think that's pretty hard to bootstrap unless you have an audience for some reason in that space already. And maybe a few others. If you had said, a few years ago, AI would have been on that list, right? Now, obviously, you can build with all of these tools with massive companies competing with each other and OpenAI selling their stuff for $200 a month and losing money on it every month. So now to build in those spaces, you don't need capital even.
And what did that, because you did this for 12 years until you exited. What did the kind of trajectory of the revenue look like, and how did you extrapolate to other markets?
Yeah, so revenue grew very fast. So we went from 0 to 1 million very quickly in under a year.
Oh,
Uh,
wow.
and then we kind of jumped to 5 million and then 10 million. And each of these were plateaus. So 5 million, 10 million, 15, 18 million. So somewhere before 20 hit another plateau. And then obviously we sold at 30 million. So each year we were roughly doubling in general. Towards the end, not so much, but now Grasshopper probably does well more than $100 million a year. So that was one of the acquirers' targets when they looked at us, is they had to get to $100 million within 5 years. I think it was maybe even 4 years. And so like we hit those revenue targets very, very quickly. But along that journey, we had all of the existential questions that entrepreneurs have. Have we reached saturation in the market? Are there still customers who are going to buy this? And we told ourselves all of these lies along the way that, we reached saturation. We couldn't do this. We couldn't do that. And it was just because we needed to grow differently as a company, either internally or externally.
And how did it change the processes and the infrastructure after you hit those plateaus and those thresholds from like 0 to 10, 10 to 20? I mean, were you changing things up? And also like with new technology, like you said, like, do people need this service anymore? Can they just, use another platform or something? But
Yeah, so I think really internally things had to change from a management perspective and a team perspective. So when we were growing from call it 1 to 5 million, we had a team of just doers. People that I would say, hey, go do this, come back to me, go do this, come back to me, right? And that only scales so far. And as you continue up that path, you need a team of thinkers, right? So then there's people that are saying, okay, we should think about these things, we should do these. I'm going to do this and come back to you, right? I'm going to do this and come back. Like that's the difference. And then at the next level, now you have a management team that is kind of directing all of those people. And now you're moved up a layer in terms of decisions. Those are hard shifts in a company. And a lot of times that breaks a company. And I'm sure we made a ton of mistakes, hired the wrong people, had to fire, had to make changes. But if you don't make those transitions, you'll never get to the next stage.
and as you're scaling these marketing channels, how are you discovering and validating these channels? How do you balance risk, reward in marketing investments?
So we had a few key theories. One, we very early on started to understand what A/B testing was and optimization, and this was not a thing that was kind of cool at the time. This was very early days when there was like one software provider doing it. It was crazy expensive. Um, so we understood optimization, we understood testing, and we then did that in a variety of ways. So one, we always spent about 10% on brand marketing, meaning we had no expectation of direct return. So 90% of our spend, we expected to measure a CPA or ROAS, all of those things, and understand like what is it that we're exactly getting. 10% always went to brand. And in that 10%, we always discovered things. We then set aside another 10 or 15% that was always pure test. We had a goal of what we wanted to achieve, but it was okay if it was zero, right? Like if we didn't meet that goal, it wasn't going to break us, where the other channels were pure performance channels. So that mix allowed us to find all sorts of things like Sirius XM, which then turned into national radio. And we spent $12+ million the year we were acquired in national radio as we scaled that channel up. But we never would have found it without running Sirius XM first.
And you said something, I forget if it was on your blog or an interview, just about identifying, when you identify those channels, you can kind of see if something's working right away. If it's marginally improving, that's usually not a great thing, but you can kind of see if it hits it out the gate right away.
So I think it really depends on channel to some extent, right? Like you have to understand the dynamics of the channel, meaning there are some channels that your expectation is you have to get to scale before you hit it. So like national radio, you need to hit these metrics along the way. First is a small test, then there's a regional saturation, then there's national. And understanding what those metrics look like, they could still be very expensive CPAs in the test periods before national, but they're directionally correct. They continue to go down as you spend more and as saturation goes up. And then you also see the tail of those, right? Where a direct channel like AdWords, that should be measured every single click, every single time, and not look at the total, but actually look at the marginal clicks, how much they are, because you can get to saturation too quickly, and you can see that in those channels. So I think it depends on channel.
And initially, when you were starting, was it kind of autodidactic? Were you learning yourself, or are you hiring experts to learn Google Ads, Google Shop, ClickFunnels, all this? I think you did Waze advertising too. Is that?
We did everything we could imagine. We did airplane ads on the tray tables. We did whatever it was. So we really felt strongly, pretty much the entire time of the company, is do the job first ourselves to understand what it is before we hire. Now that doesn't mean we became an expert in all of those areas, but we understood what the requirements were before we hired. And then we brought in experts from a consultant perspective to fill the gaps of understanding or knowledge until we could then hire, right? So like, I think it was really deeply understanding the needs so we know the right type of person hiring. Because if you take Google AdWords, for example, you could hire a strategist, you could hire an implementer, you could hire a blend. You need to know what type of person you need, right? And for us, we wanted more actual implementation than strategy. We understood the strategy of it very well.
And with those core values and your team, you mentioned that it wasn't working initially, or there were some early warning signs of growing wrong, which I think when you're monetizing quickly can hide. Can you kind of describe that and how you fixed it or remediated that?
Yeah, for sure. So for the first 4 or 5 years, we didn't voice our core values, right? So what happened was the first few people we hired naturally lived our core values because we did all the hiring. As we got a little bit further away from the hiring, then a team hired someone, there was a shift. Like there were people that were further away from our values. So we had to reinvigorate that, and we had to re-communicate as we crystallized those to the whole team. We had natural selection. Some people just left because they're uncomfortable. They're like, this is not the place for me. And now that I understand and the values are being enforced and talked about and stories are being told, there were some people we had to move out. And the most difficult people to move out are high performers that are low in core values, because you tell yourself this story again and again. Well, what if I get rid of David? He has all this knowledge, this industry knowledge, this specific domain experience, whatever it is. and we're going to fall down. But not a good performer on core values. It's the hardest person to move out. And then the third step was then backfilling and starting to add people that really live those values every day.
So it's a little more important to have those values and be not less proficient, but kind of be more of a team player than having that high intelligence on a certain topic or a specific niche.
Yeah, obviously you want A players
Yeah.
across the board. So you want A performance and A core values. However, I know that I can try at least to move a B performer to an A, right? C performers just get fired. That's it. If you're C in core values, C in performance, there's no turning around. But it's almost impossible to move a B or C core values player to an A.
Mhm.
Right? So like we have potential to move performance, we don't have potential to change values.
Mhm.
So that's why it's kind of a non-negotiable at that point.
Yeah, I'm super interested in that because it's, with Gary, I know you can ask questions up front, but is it almost like a timeline too, where you kind of get to know them? Because everybody will come in and say, "Yep, I'm going to go above and beyond. Here's some things I've done," or "I'm always entrepreneurial. I'm really passionate." Do you kind of notice those things over time, or what's that
Look,
process?
I think we all make mistakes hiring no matter what the system or process is, but we got better and better over time because we actually shifted those questions forward, like I said, but we also asked people to tell stories about how they live these values. So not, yes, I go above and beyond, like, but tell me a time you went above and beyond. What did you feel? What did the other person feel? Why? Like those types of things. And then also asking really pointed questions about performance, like, okay, you said you managed Google AdWords. Okay, how many accounts? Tell me exactly what type of accounts. What were you doing? Why? Like really digging into that from a performance perspective to understand, was someone else doing it and they were managing, like those types of pieces. So like when you combine those two, I think you get better and better at hiring.
I love that. Yeah. What was the process like with the exit? Because you weren't initially planning on selling, right? You could just bootstrap this forever, but
Yeah, we could have kept going and would have thrown off great cash flow. Citrix came to us three separate times before we really engaged in a conversation, and we kept just saying, no, no, it's not a good time, come back. No, it's not good. Come back. They kept coming back and saying, look, guys, you continue to hit or beat your numbers. We never see this, and we've made 40 acquisitions. So great job. We're super interested. And that conversation progressed over a year period until we actually kind of had a more formal conversation about it. But there was no rush, right? Like there was no timetable, there was no runway that we had to worry about or any of those things. We knew what we were doing, we knew where we were going. We were happy to invest. Like I said, we spent $12 million on radio ads. So like there's no place that we weren't willing to invest if we could get the payback.
nice. And so that was what kind of convinced you to sell is if it hits a certain mark or number more than I would just continue to run the company myself.
Yeah, so I think that the decision to sell is two things. One, is someone willing to pay far more than you think it's worth? And you have near perfect information, right? You're in the company, you know all the problems, you know all the upside. If someone's going to pay a significantly higher premium than what you think it's worth and would be willing to pay, you have to at least consider it. I'm not saying you have to sell, but you should consider it, right? Um, and then from our perspective, having some other really important factors like, are they going to keep the brand? Yes, the brand still exists today. Are they going to treat the employees right? Meaning they're not just going to cut everyone and save money and try to replace them. Like 100% of the team stayed, right? So things like that were important to us as we got through the conversations to the next step and the next step to understand like this was more than just the acquisition of a company. We truly believed in the brand and wanted that to live on.
And you had built such a well-structured management team that it was you weren't necessarily needed afterwards, right? Like you were able to kind of exit the company. And how do you build a team that with those processes, like you said, that can operate independently of those founders?
So we built around a number of kind of frameworks or processes, the
Yeah.
core of which was quarterly planning, weekly, monthly meetings, like creating that rhythm again and again and again allowed everyone to communicate across the whole company, not just on the management team, but the management team for sure, and be able to set those goals and then know that someone's going to come back and deliver them. Like we had a specific goal setting process. How do we track them? What do we do? How do we follow up on them after we do it in quarterly planning? What do you week one, week two, week all the way through, right? And that allowed us as founders to step back because the responsibility had been pushed down a level, right? But we still were very connected in the core decisions, right? Like the strategic decisions that were important, not the day-to-day operations of how we got there.
And to structure the sale, so you hired a bank to do this, or
So yes and no.
yeah,
We hired a bank late in the process.
okay.
So because we had a buyer and we did not run a process, a typical process, and I think honestly that most of that's bullshit. There are a few times when you actually have people bidding across each other, and we hear about it all the time, Cisco and Microsoft bidding and whatever, but that's not the reality, right? Like we wanted a strategic acquirer that fit us from a values perspective and was willing to pay and all of those pieces, right? But like that's not how we didn't want to run a process.
Mhm.
So we hired a banker late in after we already had an offer at a way reduced rate because they wanted to work with us, the acquirer, the deal, all of those pieces. And our goal was to have an expert on our side to make sure the deal closed. So we weren't looking for a banker to get us a deal. We were looking for someone to close the deal. And it was very helpful, right? Like there was lots of conversations that we had never experienced before that we then had someone to say, hey, we've gone through it with this acquirer, with people like them. Here are the things to think through. Things like
Had you been familiar with Citrix before, or was this through an internal network, how they became aware of you, or
So they reached out through a friend of mine who they had acquired his company.
okay,
I then also found out that they acquired another friend of mine's company. So,
that's a
I
good
think
start.
interesting, cross network there. But, really they identified Grasshopper for two core reasons at the board level at Citrix. One, they had a gap in telecommunications. This was identified externally to the board, and they needed to fill that gap. Two, in the marketplace, they needed to be earlier on. So they had a lot of customers that were larger than Grasshopper that were using Go to My PC, Go to Meeting, things like that. They needed a flow of people to push through there. So they identified this early market gap where Grasshopper had customers 1 to 10 employees. So we had the two things they needed. So we became very strategic for them.
And the sale almost didn't happen, right? Because they unloaded their SaaS entirely, right? Like whatever
Yes.
they purchased.
I bet
Like
if
a
we
nail
hadn't
biting
closed
victory.
Yeah, I bet if we hadn't closed, the sale would have like 2 weeks later, maybe 3 weeks later, wouldn't have happened.
Jeez.
Uh, an activist investor sent a letter to the board and said, your SaaS products are terrible. You should focus on your virtualization and such. And they ended up moving out about $1 billion of SaaS revenue out of Citrix at the time. I think it was a tremendous mistake if you look at what's happened to their virtualization software and other things. But there was a short period of time that there's high profitability that activist investors were driving for the short term, not the long term.
So timing was huge there. Um, Timing is great, but also like you said before, leaving meat on the bone. I think leaving kind of upside, so it's not a fully optimized company. How can you strike that balance? I guess when you're preparing it for sale, or I guess as you're growing, but still positioning it as a successful company that you've done the work, but just haven't gone into those different verticals, I guess.
Yeah, I think that acquirers really want to see upside, right? They're not acquiring a company that is perfect. They want a well-run company. They want the key metrics to be there, but they want to know like, hey, I can upsell, cross-sell. I can go into new markets. I can do these things. Not David's already tested all of this and it doesn't work or it does work, right? Like there needs to be an upside story that you can get someone excited about if you want to drive outsized returns. If you want to sell from a financial perspective purely on EBITDA, yeah, you're going to drive the highest EBITDA. You're going to optimize the shit out of all expenses, right? But if you want to drive strategic value, That's about showing like, what does this look forward, like what can I look forward to? What are the opportunities that have not been, but are very possible and visible?
Mhm. And what was the meat on the bone with Grasshopper? What did Citrix see that they could kind of optimize?
Really upsell, cross sell, right?
Okay.
So could they sell more of their customers on Grasshopper, or could they sell Grasshopper customers on their stuff, right? So like those two things could equate to values multiples bigger than our $30 million a year of revenue, right? So that for them is very intriguing, right? Compared to, hey, we can save $1 million on cost because there's some duplication and whatever, right? Like, no, we could get $100 million of upsell and cross sell just based on their customers and our customers. That's all upside to them that we couldn't realize on our own, obviously, but they can, right? And so now they're going to pay forward to us that upside.
Mhm. And that was probably one of your first forays into M&A, and now you're acquiring companies yourself. What are you looking for? And I think you said you have these 11 metrics that you kind of for your guiding principles for it.
Yeah, so really the highest level, I look for $2 million plus of EBITDA, kind of two to call it 50, right? I'm a different type of buyer than Citrix. I'm not a strategic buyer, I'm a financial buyer, right? So my metrics are very different of how the things I look for and the things I want. I want things that are not necessarily high growth, but are durable, that are stay around for a long time, that the demand continues kind of no matter what happens in the market,
Mm.
which is interesting. We saw at Grasshopper, right? Like as the economy went down, our demand actually went up. More people start businesses as they lose jobs, right? So that type of a thing is very interesting. And I'm also not picky on industry, meaning like it doesn't have to be SaaS, doesn't have to be this. Like I'm looking for things that are going to stick around. From there, there's a lot of metrics that we look at, but that's at the highest level. Is this going to stay?
Would you say it's evenly split between like D2C brands and SaaS, or are you focused a little more on a certain area?
So it is probably roughly evenly split, although I'm not looking at direct to consumer brands anymore.
Okay.
Uh, I'm not necessarily convinced of the long-term play there
Mm.
as I was in the past. So, but similarly, I'm also not convinced that SaaS is the best place right now either. I think there's too many SaaS products and there's too many people charging recurring monthly fees for things that shouldn't be.
Mm.
So there's this fatigue in the market across, I think, even consumers, but definitely businesses, right? They're like looking at these invoices like, I have like 50, 60 products that I'm paying for. It's too much. I don't need another one. So I'm a
Mhm.
little concerned about that fatigue in the market from a SaaS perspective. So I'm quite interested in places that are disrupting that and have, different pricing models and different ways of selling that are based on a different metric than just, how many seats or how many people or things like that.
Gotcha. But you're still invested in Perfect Keto, or is that
Yeah, yeah, absolutely. So I no longer run that company,
okay?
but yes, yeah, I still have investments there, as well as a number of other companies now in the medical space. So have a number of medical assets, including an urgent care and med spa. So that's a very new space for me, and I love learning and growing, and for me, that's 100% new. So I love it.
Are you keto, or are you a proponent of the fat? I just
Yes.
switched to the carnivore diet, and it's that initial switch from, your energy from carbs to fat. There was like a 2 day period. It was like keto flu or something, and that was miserable. But now it's just constant lucidity, clarity. It's the best I've ever felt. I'm sure I'm going to be tired of just eating sirloins, but
So I did pretty strict keto for 8 years probably. Really loved it. I did carnivore for a period of time. I got kind of bored, to be honest with
yeah.
you. Like I like vegetables, so I was like, I don't see a reason that I don't want to eat them, right? Like I understand the low carb and like why that works. Today, I'm actually not keto. I'm down about 30 pounds on a pretty strict macros based diet. So I'm cutting down. I probably have another 10 pounds to go. And then my goal in this year, 2025, is to add about 30 pounds of muscle back. So
Okay.
really changing kind of my whole body. And that required, you can't do that on keto. The fat content's a little too high, the protein content, not enough carbs for the amount of workout that's required.
Yeah.
So it's been an interesting switch for me. Like having oatmeal in the morning is like crazy. But I love it.
I feel like I was a vegetarian for 6 years, and so I've been kind of going between these kind of restrictive diets, but I feel the healthiest on carnivore, but I'm sure I'm going to want to introduce more foods over time. But yeah, so with you as an angel investor, 50 plus companies, you've done Intercom, Unbounce, Groove. Do you, when you're looking at these successful startups, how do you evaluate these potential investments? You kind of said before, like staying power.
Yeah, so angel investments are a little different than what I buy. So
Okay.
to me, I look for two things. One, more than $1 million of ARR or revenue. Like to me, that's just, is there a demand in the market? Like, is this been proven enough for me to take the time to understand and listen and look? And then two, can I learn? Right? Because my portfolio from an angel investing perspective, I think is probably break even. It's maybe even positive because of a few outliers that were pure luck. But my learning has been tremendous. Learning new industries, learning new technologies, and then giving back to founders that may not have been typical capital raisers, right? So those areas to me are much more important from an angel perspective than is this just a great return? Now, I also passed on Uber, so that probably wasn't the greatest idea, but this was never a way for me to generate capital or returns.
Okay. And at Grasshopper, you did use debt initially to fuel growth. Um,
So
how
we use debt in the later years,
later?
not
Okay,
the beginning. Yeah.
gotcha. Yeah, I was just curious to how startups can kind of responsibly use debt to scale and what pitfalls they should avoid.
Yeah. Yeah. So we use debt most notably in our kind of last 2 years before we sold. So being able to one, pay for a radio budget of $12 million, have to be able to do something, right? Like they're not just going to say, sure, pay us later. So but the key there is we had found things that we knew and already had proven if we put $1 in, we get $2 or $5 out or whatever our return is, right? That's where you can use debt within a company, not to test new things, to bet on a new market, to hire people to do this. No, no. Debt should be used when you know the return profile, you understand the cost of the debt, and including the cost, the return profile is still significantly better. That's where you can use it and not get into trouble.
And there was definitely benefits, I guess, with that. With starting with just two people, you were super scrappy. Weren't you negotiating deals with when to pay back or lower rates on debt?
Sure, yeah. I mean, of course, like we tried to negotiate everything we possibly could when we were starting. Like,
Yeah.
will you give me 5 more days on this? Whatever it is. But what we ended up discovering is we could create a positive cash cycle. So we would sell someone a phone number and their minutes. They would pay us ahead. We would then have 30, 60, or 90 days, depending on the vendor, to pay those bills. So we were always in a positive cash cycle because of that. So in essence, customers were fueling some of that funding naturally, right, with that positive cash cycle. So anytime we could do that, we were super happy. So hey, vendor, give me 60 days and let me pay on a credit card. Now I've extended that to 90 to 100 days, depending on what day I put it on the credit card, right? So things like that, and of course, getting points because of the credit card is a whole nother benefit. That type of activity, if you're smart about it, can generate huge leverage. But if it doesn't matter to you and you don't care as a company, you're like, oh, 15-day terms and pay, right? We didn't have that luxury.
And how is it different now, I guess, with the startup ecosystem than when you started? Definitely different industries, kind of, but newer tech and how people are raising money.
I think what's different today is there's a lot more saturation. So I feel like it's easy to start and it's hard to get traction. Because it's easy to start, there's lots of competitors, there's lots of people doing things, which is great in the long run. but it is harder to get that traction and attention. Where I think if we look back to our early days, we could buy clicks for 1 or 2 cents, right?
Wow.
So
Yeah.
that doesn't exist today, no matter what market you're in. So I think getting attention is more difficult, but the true benefit is the cost of all of those things is free or relatively free for all of the infrastructure required to start a company.
Do you think it's necessary? I'm just looking at, my platform, but to be almost, you have to be this like solipsistic microcosm. You have to be in this a creator that kind of pushes things out sometimes. Or I just noticed, with Prime, Logan Paul's D2C brand, just everybody's kind of launching these auxiliary products within their ecosystem. Is that something different as well?
I think today, what I think is most important is an owned audience.
Yeah.
There's so many rented audiences, and I think we're starting to see that shift more and more. Obviously, people that built huge followings on YouTube are trying to figure out how do I take that following off YouTube into other channels. Part of that is auxiliary products, but other parts is directly on Netflix. Now, that might still be a little bit of a rented channel, maybe less so, but like, how do they continue to move on that spectrum to owned audience?
Hmm.
That's one of the reasons that email lists are very, very interesting right now. And people continue to do very well in that space. It's an owned audience that cares, that can't be taken away. We saw this with TikTok, like that disappeared for a few hours as a PR stunt, but that was serious, right? People were like, my audience could be gone. And that's a difficult thing to understand, and hopefully people learn from that.
With newsletters, you have a massive newsletter, 10,000 subscribers. How do you build that? What is the first few steps? Is it just kind of always pushing it out? Are you doing marketing with that as well, or?
So for me, it was just starting the process of writing. Like I started with 0 subscribers. I asked a few friends, can I add you, right? And just building that rhythm again, back to rhythm. Every week writing again, every week writing again. So building that habit and that rhythm, and then it naturally expanded from there. One, I had a network of people that kind of were listening to me already, if that was LinkedIn or wherever. So how do I get them added? Those people naturally add. Today, I am doing more marketing, right? So maybe podcasts to some extent, but also direct channels. Who can I partner with? Things like that to build that list over time. And it's interesting because I don't monetize the list at all, and I don't think I ever will. For me, it's been a great experience of being better at sharing as a human being because I have to write every week. So I've loved that accountability of it, but also the connections, like hearing from people I haven't heard from in a long time. Hey, love this week's newsletter, love this specific thing, and then reconnecting with them. Things like that have been super valuable.
Yeah, I love the books that you recommend on there as well. What were you involved with Sam Parr's hustle at all? Did he give you some tips on starting the newsletter and stuff? That's kind of how I heard about you because he always mentions you in every episode. But
So I love Sam. I was one of the early investors at the
oh, okay.
Hustle. So saw the newsletter really grow from a conference to a newsletter and continue to grow from there. I think Sam is fantastic from a content perspective. He obviously built a very successful newsletter, but now has built multiple podcasts that are massive,
Mhm.
uh, has a huge following on a number of channels. So I think he really gets content. And I appreciate that about him. Like he challenges me on a number of things. Like he's like, dude, why are you writing about that or whatever? So I appreciate that, and he really gets it.
Okay. And yeah, it's like some people are trying to create these newsletters to sell later. Are they monetizing now, or is it kind of like, hey, let's just build the audience and sell later so that, a HubSpot can acquire something like that?
I think it depends. I think if you're, the hustle or morning brew, you're definitely monetizing early and you're looking for an exit. Like, what does that next step look like from a media perspective? For for people like me, I think it's about building audience, and it doesn't really matter about monetization, right? Like if I never get a single dollar from the email list and I never sell it, it still will be very impactful and beneficial to me as I build the audience, right? So I think that there's a difference of who's building and then why.
Yeah, I think it's you can kind of tell too if it's just something that's being monetized or somebody's truly passionate about it. Like it's I love reading Naval Ravikant's or even Vitalik Buterin's musings of the things that I can understand from there. But yeah, you can definitely tell with that. And yeah, with you with multiple exits, what is personal success now look like for you? Family, health.
Yeah. So I think it changes year to year, but the overarching is happiness. Like I made a decision a number of years ago that like I was going to say no to things that just didn't make me happy or I didn't enjoy, even if that made me a dick, right? Like I just don't want to do that, or I just don't want to go there, or whatever it is. The money hasn't changed my life. I have the same car, I live in the same house, like all those things are the same. I fly on Spirit Airlines. I mean, I pay for the big seat up front, but it's $50, right? Those things haven't changed, but what has is my ability to say no. I can say no to anything for any reason I want, right? And if that's because I want to spend time with my kids, I want to travel, I want to go to the gym, I can just say no.
Yeah,
Right? And that to me is really the power that money has given me or wealth has given me. Um, and as I think about what's important each year, like 2025, I decided to refocus on myself from a health perspective, losing weight, gaining muscle, doing those things. That's just a short-term thing, right? Like that's this year. That's not a big picture conversation, right?
so yoga takes precedence sometimes.
Last year it did, maybe this year it doesn't,
Yeah,
right?
yeah.
So I haven't practiced as much. Last year I probably practiced 6 days a week. It's a little bit hard on the weightlifting regimen I'm on now, but like to me that it doesn't really matter what the activity is anymore. It's am I focusing on myself? Do I have time that is about me so I can be my best self to show up for others in my life, right? Like if I can be my best self, I can show up for others. If not, I'm falling down. There's no way I'm showing up for friends, family, anyone.
It's true. Yeah, that's primary for sure. And as you look back from Grasshopper to Chargerfy to Vanilla, what are there some decisions that you're super proud of, like one decision that you made, or and maybe some things that you wish you had done differently?
Yeah, I think that the decision to really hire people smarter and better than me across all of those companies has paid off. And people always say it, like it's easy to say, hire people smarter than you. I get it, I get it. But it's actually uncomfortable, right? Like when you actually dig down and you're like, okay, like I'm not the best in this. I'm never going to be the best at this. That's an uncomfortable thing to internalize and understand. But that's how we become great leaders. That's how we build great companies, is we actually have to accept that and understand it, not pretend, not be like, well, I'm sort of hiring this person, but I can still do it better, right? Like I think that to me was what has been the theme of success across all of the companies. So I continue to try to do that and surround myself with people that are smarter than me and better than me. Like, how do I stretch myself? How do I get to that point, whatever it is? If it's business, fitness, family, like, how can I strive forward? I have to surround myself with people that are ahead of me, right? Um, in terms of decisions I regret, it's a hard question because I don't really like looking back. I think to me, the journey matters more than anything else. And every one of those quote unquote bad decisions is part of the journey. It was part of the learning process. It was part of the pain that got me to where I am today. So I don't like looking back at them as like bad decisions or something I would correct. It was just the journey. That's it.
Because you were kind of figuring out everything as you go. I mean, just navigating relationships with investors or boards or acquirers. I mean,
Not an expert. Like we weren't anything special. We were just willing to learn and accept when we were not the best, hire the best, and continue on that learning path. That's it.
nice. And last question, any good books you recommend? Any
It depends on the topic.
business book guy, or are you also, literary, looking into the Pulitzer Prize winners, or what's kind of gets you
No,
going?
I'd say 95% of the books I read are nonfiction. So that could be history. So I love history books. I love that whole genre. I love that. I don't really love self-help books. but there's a few that stand out to me as important or good. They're definitely on my reading list on my website. As of late, I've been focusing on kind of wealth and psychology around wealth. So really enjoyed Psychology of Money last year when I read that. That was at the top of my list. A few others in that category. Just kind of thinking about like what does wealth mean to other people? Like I know what it means for me, but like I want to learn and understand other people's perspective.
Okay. I love that. Well, dude, thanks for coming on. I really appreciate you taking the time to do this. I know you're super busy.
Yeah, I appreciate it. Absolutely. Thanks for having me.
Shout out to Julian Banks. Yes, sir. And I am Big Snoop Dogg.